Good afternoon, everybody. How are you? I am so excited to be joined by the brilliant Rose Macfarlane, partner at Irwin Mitchell, for this Essential series. So this afternoon, we're going to unpack the headline changes to do with inheritance tax following the budget last week. We're going to be looking at the shifts expected in the coming year, along with some of the strategic actions you and your client should prioritise before the year end, or the tax year end, to safeguard flexibility, family fairness, and liquidity. So, as always, if you do have any questions, feel free to pop them in the chat. Otherwise, if you're watching this on the replay, feel free to reach out and we will answer any questions that you may have. So, I'm just going to get Rose in now. Good afternoon, Rose. Hello, how are you?
Very well, thank you. Yes, and gloriously sunny day.
It is, makes such a difference to energy levels and enthusiasm. And I'm really excited to be having this conversation with you. I know there is a lot for us to get through in this conversation, and you are the lady for the job. And I'm really excited to learn more from you. So you are. So before we get started, could you just share a little bit about yourself and your practice?
Yes, sure. Well, I'm a partner at Irwin Mitchell. And my area of specialism is what we call private client. It means that I advise individuals and families on estate and tax planning, thinking about the succession of assets, how they hold assets for tax efficiency during their lifetimes, but also thinking about those capital taxes on death and what's going to happen, who's going to inherit what. And sort of trying to do all of that with a sense of keeping the family unity, and also preserving a business, etc., going into the future. So it all wraps up into a sort of complicated mix of advice.
Yeah, well, I think, harmony and inheritance are two things that it is a particular skill set that is required to maintain.
Absolutely.
But before we get into the changes, I think it'd be really interesting to actually understand some of the context around the history of inheritance tax.
Sure. Well, it's a sort of an interesting tax. It's been around a very long time, but in different forms. So there's been some sort of what used to be called estate duty since the late 1890s. So it's been around a long time, and there's always been some way, some element of farming land and farming assets being subject to a level of relief. That's sort of been a constant through. But really, the sort of big changes occurred in the 70s, 80s, and 90s. And that's when the idea of commonplace things that we have now, like the 7-year rule that most people know about. You can make gifts, and after 7 years, it's outside of your inheritance tax estate. Well, that concept was actually preceded by an entire lifetime of accumulation of every gift you ever made. And that was only broken down in the 80s. It's really much more recent than people think. It's quite extraordinary. So in 81, a 10-year accumulation period was introduced. But really the big changes to inheritance tax and the idea of there being full exemption for business property under what we call BPR, business property relief, that only came in 1992. People think it's been around for a very long time, but actually it really hasn't. And there's huge changes have happened in like 2006. There was a lot of change at that time. And I don't hesitate in saying that the changes that were announced last October, in October 24, they are sweeping. They are quite revolutionary in their impact. So I'm happy to be unpacking them today for your clients and members.
Thank you. Thank you so much, Rose. And yeah, I think it is really important for us to look back to be able to then take action looking forwards and think about, what normal looks like and the fact that we are always in this ever-changing tax landscape. So I think focusing on what's happening now with what's just been announced in the budget, could you share an overview of it specific to inheritance tax and why it matters at the moment?
Sure. So, well, obviously the central theme around the budget was very much about raising revenue to reduce debt and to fund investment in public services. So we all understand that. To be honest, for the inheritance tax changes, the main stuff was actually, as I said, in October 24. And that brought in some sweeping IHT reforms. The sort of the headline is that there is a £1 million cap or allowance on business property relief or agricultural property relief assets, which can be passed on to the next generation. And then anything over that value is taxed to inheritance tax, but at half the normal rate. That doesn't actually come into effect until April. And the other big one, which I think has affected a lot of people, is pensions coming into the inheritance tax regime. And again, that doesn't come into place until April 27. So there is a bit of time on that. There are, the thing about the APR, I use the short terms, and I will remind myself to say it properly. Agricultural property relief, commonly known as APR, and business property relief, commonly known as BPR. I'll keep using those acronyms now. So what it must be said, though, is that the tax that is potentially payable can be paid over 10 years without interest. So there is a little bit of consideration given to that, but there has been very bad reaction in the press, as we're all aware. What's clear from the last budget is that there's no rowing back on these plans. So the budget that we had last week didn't give us any succor. Apart from one thing, which is very important, the allowance, as it was announced last year, the £1 million allowance, offered no possibility of that transferring between spouses. So if it wasn't used on the death of the first spouse, it couldn't be used on the death of the second. Now that flies in the face of all of our other allowances in inheritance tax. And that has been addressed by the government in the last budget. So now there is what we call a transferable allowance between spouses. So that's good news. But it still only gives us a total of 2 million for business property relief and agricultural property relief, which for people who have assets in these areas, that's not necessarily enough. And it's certainly not enough to reduce the enormous impact that the tax will have on their businesses. So I think the fact that we've got a gap now between these things coming into effect from next April means there's a massive opportunity right now for people to take some action. It is about now. It really is. So for business owners and farmers, they need to take action to potentially mitigate this inheritance tax liability in this very short time period. There's a lot of prep that needs to be done in order to do that. So very detailed valuations, potentially clearance with HMRC, etc. So most definitely the advice is take advice as soon as possible if you're in that boat.
Yeah, definitely. And I think, it really resonates the fact that, although these do sound like large sums of money or large sums of relief, proportionally to the value of these farms and agricultural estates, it is still not enough for them to make, significant, change, impact on the gifting down as a legacy. But I guess from your perspective, which of these reforms are most significant for families and wealth holders right now, to help us understand the real world implications for estate planning?
Well, I think the one that was announced that isn't an inheritance tax event, but it nevertheless has affected a lot of people with any sort of wealth, is the so-called mansion tax, which has massively dominated headlines, which will be an annual council tax surcharge of at least £2,500 on properties valued at over 2 million. So that's a bit of a blow to property owners who are asset rich but cash poor. And of course, it will very significantly, disproportionately affect those in London and the South East. Apparently, 80% of all properties worth 2 million plus are in London and the South East.
Wow.
So that could have quite an impact on a certain type of individual who as you say, has a valuable property, but nothing else really. There is a payment deferral scheme. We're yet to see the detail of that. The implication is that it can be sort of rolled up into a charge against the property that's repaid when the property is sold. But as I say, we don't have the detail on that sufficiently to be able to say that that's going to work for a lot of people. But to be honest, there's without doubt that the biggest impact on wealth is the changes that I've already talked about in relation to BPR and APR, but also pensions. That's going to really have a significant effect on the whole nature of planning around this. And a lot of people who will have done wills or spent a lot of time with financial planners and advisors like me really need now, over the course of the next year or two or whatever, to really revise and have a good look at what they're doing and check that it's right for them and their family.
Yeah, absolutely. And I suppose we can't have a discussion about tax or law without talking about misconceptions. There's always urban myths and assumptions, but what are you seeing as misconceptions amongst clients to do with these new rules, or just in general?
Do you know, I'm really pleased that you asked this, Lottie, because there was a misconception of a client of mine that I had in the last week or so that I was actually a bit floored by, which I know it sounds really simple, but he was absolutely convinced that this is all just gossip and it won't really happen. And
wishful thinking.
With all the respect in the world to him, I mean, he's an extremely successful businessman, but that ain't the case. It is going to happen. This is absolutely going to come in. There's no reason why the draft legislation will be will not pass through. It will, and this will be in effect. But I think overall, the biggest misconception is that people think that there are quick fixes, and there aren't. We've got this beautiful little window between now and next April to do a lot of steps around gifting to mitigate the inheritance tax that might eventually be due. However, there are limits, and certainly after April, when it comes to APR and BPR assets, there are absolutely going to be limits on what can be done. And it will be more important for people to start earlier with their estate planning, whereas usually we say 50s, 60s, even 70s, that's fine. But actually, we'll be saying to people, actually start thinking about it sooner. I think also there's a real underestimation of the complexity of tax rules. They are so intertwined. There are so many different things to consider. So one tax impacts in one direction and you think, great, I can do this to mitigate that. But then there's another one happening in the other direction. So that sort of constantly understanding how these things work together. And, it doesn't give me joy. I mean, it gives me a job, but it doesn't give me joy to say to clients that, look, you actually do need complex advice on this, because everything you do will have an impact. Every decision you make around your wealth will have a tax implication. It may not be immediate, it may be down the line, but you need some help to understand that. I think that's pretty good, pretty important point. And the other point, I guess, is family disharmony. People underestimate how much there is the potential for family disharmony. And of course, where there's a will, there will be disharmony if you don't act carefully. So it's really, really important to look at all this in the round with somebody who is helping you navigate those issues, for sure.
Yeah, well, definitely. It's balancing the emotions with the economics, which is where you guys come in to help to navigate that that very potentially disharmony. I don't know, whatever that word might be.
I don't know.
But I guess, who do you think is likely to feel this change the most? And I know we talked about being proactive and taking early steps, but what might these early steps look like?
Yes. So, well, obviously, without completely getting this taken over by business owners and farmers, it was without a doubt they're the most affected by the changes that have been announced over the two budgets. And for them, there's this critical window. But for the much more numerous amongst us, it's the pension changes that are really we're all going to feel that when our pensions are lumped in with all of our other assets for the purposes of calculating inheritance tax. So I think there's be having a bit of feedback. Is that just me, or am I
I'm
don't
fine.
know. Oh, okay. All right then. So I can hear myself coming back out. So apologies. But yes, so I think looking at your pensions and particularly how they're nominated can be a really, really important step here. And thinking about that in the context of your overall estate planning, whether you've factored that you may actually lose an allowance. There's a particular allowance called the residence nil rate band, and it kicks in on estates worth 2 million, or sorry, it sort of drops out on estates worth 2 million or more. Mm-hmm. And when people have, maybe a relatively, they're not in London because of property prices, it's probably unlikely, but maybe they're outside London and they're living a comfortable life with a home and, other investment assets, etc. And they've got a pension tucked away for, I don't know, $1 million or something like that. All of a sudden, that being brought into account means that they may well exceed the 2 million by some margin, which then in turn means that they will lose out on an allowance called the residence nil rate band. And that allowance is worth, it's worth a decent amount of money. It's a total of 175,000 per person, 350,000 per couple. It's a lot of money.
Yeah.
And so the bringing in of the pensions into the inheritance tax regime is sort of shocking, and it completely changes our notion of what are the priorities for how we use our wealth during our lifetime. So I think the sort of the who's going to be affected the most. Well, it's anyone whose combined estate is now going to exceed 2 million. Who otherwise was perhaps around that mark. So yes, they'll be affected the most by far.
Yeah. And I think, one of the big incentives for pensions is to get people to actually use them within their lifetime as a pension. Absolutely. Rather than having them set up as, a tax-free gift later down the line. So we might see different ways of structuring assets and using different buckets, let's say, while people are accumulating their wealth in order to transfer it to the next generation. And while we're touching on structures, I suppose, for clients using, say, a corporate or a trust structure, how might some of these relief restrictions change the long-term planning?
They absolutely do, for sure. Trusts have been popular for a very, very long time, particularly in relation to passing down business and agricultural assets to the next generation. And one of the reasons for that is because you could put those assets into trust at a 100% relief. So there was no tax charge on the way into the trust. Focusing on inheritance tax. Capital gains tax, slightly different, but again, you could usually pass the assets into a trust without capital gains tax either. Now that we've got the 1 million allowance coming in, that changes. And it's one of the reasons why there's this short window to do some serious work. because from April the 6th, you will only in your whole lifetime be able to put 1 million of those sorts of assets into trust. You regain it after 7 years, and so there is the possibility, you know, in a similar way, you've got this sort of like you do with other gifting, you can every 7 years you can do a bit more, but it is a real problem, I think, for a lot of people, and it does perhaps make trust slightly less appealing and more complex for some people who are planning succession. But I still think trusts will always have a very, very important role to play in administering estates and in providing for the next generation for non-business assets. So whilst they do still have that role to play, there is definitely a shift towards more corporate structures for succession planning for high net worth and ultra high net worth, for sure, particularly in respect of business and investment wealth. I'm sure you know about and have used and heard a lot more the term family investment companies. As a very nice colleague of mine said recently, yeah, it's just a company that we call something slightly different. It's nothing, it's nothing particularly fancy. And I was like, oh, okay, that's really helpful to know. But basically, a family investment company is a company that is set up to hold family wealth. And usually it is in the form of business assets or investment wealth. And you can arrange the share structure, the share capital, in such a way that you ensure that individuals within a family have particular benefits to gain from the company over time. So there are all sorts of arrangements that can be put in place for that, and those are without doubt becoming more and more popular, and offer just a very it's a different way of looking at succession to trusts, has similarities, and actually the two together often work alongside each other. So you might have trusts actually owning shares in the FIC, the family investment company, as part of the overall family estate planning. They're not going anywhere. There'll be a lot more use of these things over time.
Yeah. And as you said, you know, it totally comes down to each individual family or individual business owner, whatever it might be, you know, thinking about how the best strategy will work for passing down and creating a harmonious legacy, to reduce friction later on, and try and mitigate some of these taxes, which can be a little bit tricky to navigate in its own right. And I think it would be sensible for us to touch on AIM shares, which have predominantly been very useful for a lot of people for the BPR relief. But if you want to give us a quick overview on how that looks, you know, previously and currently, that would be really helpful.
Absolutely. So the AIM is the alternative investment market, and it's a subsection of the London Stock Exchange, the LSE. It was created with the goal of actually helping smaller, perhaps riskier companies have access to capital via the public market, and those companies wouldn't qualify for listing on the LSE, which is how AIM came to be. Because of the nature of those businesses, it was decided that AIM shares, as long as they were held for 2 years or more, would qualify from 100% business property relief from inheritance tax. However, the budget in 2024, last October, announced a fundamental change to that. So instead of there being 100% relief from inheritance tax, it's a 50% relief. So it effectively, because the rate of inheritance tax is 40%, so AIM shares now have an inheritance tax rate of 20%. And there is no allowance like there is for business property relief and agricultural assets. where we've got the 1 million allowance, no allowance for the AIM shares. As was always the case, you still have to have a 2-year ownership qualification. But that was one of the reasons for AIM being so useful as part of a financial strategy and part of a tax mitigation exercise, so that there would be people who could they could expose themselves to some mitigation by putting funds into AIM, but perhaps only a relatively small percentage of their investments, so that there was the potential for limiting inheritance tax, whilst at the same time having access to those assets, which of course, if you give away assets and wait 7 years for them to drop out of your estate, you can never touch them again. So AIM offered this sort of midway point. And indeed, the government have clearly decided that that midway point therefore deserves a mid-rate inheritance tax. So that's where we are now with AIM. Again, that kicks in from next April.
But it's also a massive disincentive, it's massively disincentivizing capital for these new new companies. It just seems that the government is really trying to stifle entrepreneurship in a way.
Well, I think I completely understand that thought process, and I wouldn't wholly disagree with you at all. I think on the upside, though, what it does mean is that there is still mitigation in putting investments into AIM. And I think the underlying businesses and indeed the advisors around it will have to work harder to demonstrate that it's worth it, because there is always a higher risk with AIM shares, precisely because they are, startups and private companies, or relatively speaking, private companies. So it's it always comes risk and reward are always payoffs in this world, and it seems to me that the AIM listing is no different to that than it was before. But there is that possibility. I'm sorry about this sun. There is that possibility of some mitigation, at least. We're not losing it entirely. I try to look for the silver linings to every cloud, Lottie. I mean, this is a very grey cloud. This all the inheritance tax changes. But if we sort of point out one or two little silver linings, at least it might give people some sense of, well, okay, it's happening, but there's a little bit of joy.
What we can do to work around it. Now, we've just had a question that's popped in, which says, may I ask, who has control in such trusts? For example, if a divorced couple wants to control their own portion of shares within the family trust, can they do so? Okay, do you mean a trust in general, or are you talking about the fix? Or does that question make sense to you, Rose?
I can only think that the question has come out of a situation where there is a trust that owns a portion of, or maybe the whole of, a company that is primarily a family company, be it investment or otherwise. And there's a divorce going on, etc. It's a toughie, that, because generally speaking, with family companies, I would be certainly trying to arrange things so that divorce did not impact on the ownership of the shares. One of the things that we talk to families a lot about is, and you will have heard of these, prenuptial agreements, postnuptial agreements, and not just specifically around the company shares, but say, for example, a gift. So you might be making a gift of an amount of money or a portion of shares, and to one of your children, and say, well, I'm going to do that, but I want you to have a postnuptial agreement to make sure that your spouse doesn't have a claim over this. And I can only think that the situation that the person writing the question has come across is where none of that took place. and we're going to have a little bit of a confrontation here potentially. Sounds like a little bit of advice will be needed, both from potentially someone like me, as in a trust lawyer, who can help navigate the legalities of the trust and the ownership of the assets within the trust, and how that might be sort of separated so that there isn't complete and utter putting everything in the same basket and everybody having to get on. There is a degree to which we can sort of create sub funds to make that a bit easier. But actually, if it's all going wrong, then of course it may be something that you need sort of contentious advice on. Yeah.
Good.
Difficult
okay.
one.
Well, question asker, I will be in touch with you after this call. And we will get this sorted for you. Brilliant. Thank you so much, Rose. So one of the biggest headline shifts is IHT being applied to most unused pension savings and death benefits, as we just touched on. What does this actually mean in practice?
Yes, this is a biggie. As we said, you've been planning to preserve your pension wealth as an inheritance tax-free legacy for the next generation. People have been organising their nominations to make sure that they provide for spouse, but also children. It's all been very clear since 2015. We've had a good run of how this regime works. And that has made a huge impact on the use of pensions as a savings tool and as an inheritance tax tool, the inheritance tax mitigation tool. So a lot of people have piled a lot of money into their pensions, particularly in more recent years. And I am not surprised that many may feel it's a little bit of a betrayal to then have that turned on their heads and be told that no, that's going to be part of your inheritance tax estate. Yeah, real toughie. The traditional advice was spend down all other wealth, keep the pension as it is. That was always the standard advice, because that was inheritance tax free. Obviously, that advice is literally now out the window. And we now have to think about how there is an overall plan which includes the pension funds in the estate planning. And it may be that there's more gifting of the free estate, of the non-pension estate. One thing important to remember is that death in service benefits, which are the death benefits that are paid from a group policy that your employer takes out, are not affected by the death benefits that are talked about in the legislation. So it's really, I think a lot of people were quite worried that these were going to be taxed, and they can be potentially quite significant. I mean, most people who have death in service will have 4 times salary. Sometimes it's even up to 8 times salary. It's a very substantial amount of money potentially for a lot of people. But it is still, I would say, on death in service benefits, there is still a very important tax planning point on this, which is to ensure that those benefits pass into a trust on your death, so that they don't inflate the value of your surviving spouse or your children's estate, whatever it might be, so that it's taxed on their subsequent deaths. So there is still a place for doing some planning with your death and service benefits. But yeah, these are really big shifts. I mean, we've talked on and off all through this half hour about pensions, and I think it's going to really, people are going to feel that pain over the coming years, and it really is going to be a whole readjustment about how we view our pensions, how we save, etc. I mean, fundamental shifts there.
Yeah, and the importance of planning and good advice early on, I think, is just the underlying, theme that needs to be addressed as well. And on that note, I suppose, if you could give clients or anyone watching top 3 actions to take before the financial year end, what would they be?
Wow, I've said it enough times, but if you have EPR or APR assets, get some advice pronto. I think that's the most important takeaway, without a doubt. I think it's generally reviewing estate planning and your wills is always a good idea. Think about also bank of mum and dad implications. There's a, you know, we all want to be very generous to our children, and we all want to look after them in various ways. But we need to think about protecting those gifts and maximizing the value out of it. And, you know, to go back to the questioner's point, is that you want to make sure that if there's a breakdown of relationship in due course when there's been a generous gift, that's not wiped out by a relationship split. But the other big thing is really reviewing your pension, pulling together all your pension information, getting some financial planning advice in relation, your pension specialist advice. Is it all in the right place? Would it be better consolidated or not? Sometimes not. And very importantly, think about your nomination. The nomination very much crosses over into estate planning. So I think it's always a good idea to run that conversation alongside your legal advice as well as your financial planning advice, because the two very much go hand in hand.
I think that's a really good point, and that's often overlooked, because if you've got, say, one son, or, you know, a son and a daughter, but you've put, you know, all of the beneficiary nominations to one of them, and they will end up inheriting, you know, all of it, then they're going to have a huge liability later on, and it will again, you know, mitigate the benefit that you're trying to achieve. So yeah, as you rightly say, it's matching up the emotions with the economics. Absolutely.
Well, there's another interesting point to make on this that I'll just chuck in there very briefly. Pension trustees are discretionary. They can choose to whom the funds go. So you make a nomination. That's why it's called a nomination rather than a direction. So you say, I nominate these people to receive my pension in these proportions. So the trustees look at that and then go, well, we like it, we don't like it, it doesn't fit with our idea of what they should or shouldn't be doing, and they act accordingly. And they really do. There's no two ways about it. They do exercise their discretion. So when you're looking at your nomination, it's incredibly important to explain very carefully why you're doing what you're doing with your pension and how that fits into the wider estate planning, which is why I say, you know, writing that nomination with a lawyer who's looking at your estate planning is really, really useful. Because you want to avoid the trustees turning around and saying, oh, we don't like that, we'll do something different. And they do. So, yes.
And by that time, it's too late for you to have a say.
Absolutely. Yeah.
Interesting. Well, I love that. And I'm really conscious of time now, but although we could have this conversation, you know, I've never had as interesting discussion about pensions, and I'm sure a lot of people tuning in agree. But it is so important, and you bring so much light to it. So thank you so much, Rose, for all of that. Thank you to everyone who's tuned in or is watching us on the replay. Question asker, I am going to give you a call straight after this, and we'll get that all sorted for you. But yeah, thank you again, Rose, for sharing all of that, and to everybody, really appreciate you sharing your knowledge.
It's been an absolute pleasure. I'm sorry I've had to skirt around to avoid the sun coming on me all through. But,
unexpected risk there. The sun, we were not expecting that in December.
No, and I thought I had the curtains in an appropriate place, but clearly not.
You're
so
fine.
Apologies for that.
No, you are fine. Thank you. Thank you so much. Right, I will see you all very soon. Thank you.
Take care. Bye.
Bye-bye.